Hi everyone, thank you for joining us this evening for our webinar, Credit Myths, How to Avoid Common Mistakes That Could Be Costing You. My name is Kelly Blount and I'm the Program Marketing Specialist here at General Electric Credit Union. We're so glad you've joined us as we have a great discussion planned for you, and we wanted to thank you all for tuning in from the comfort of wherever you may be joining us from. Before we get started, please note this meeting is being recorded. By attending this webinar, your attendance is agreement to being included in our recorded session. Additionally, I would like to take a quick moment to share a poll. This poll is asking you to anonymously share with us if you're a current member of GECU or not. Our webinars are open to both members and non-members. However, this poll gives us just a little bit of a better idea of who is joining us tonight. So I went ahead and launched the poll for those of us who are joining us, just a simple yes or no, and if you're currently a member of GECU. As I mentioned, our webinars are open to both members and non-members, but we just kind of like to see where everyone's at. So I'm going to leave that open for just another moment or so, and then we will continue on with tonight's content. All right, thank you to everybody who submitted answers for that. So now we will go ahead and jump into a couple housekeeping items. If you've joined us for webinars before, you may remember the rundown, but if you're new to our webinars, welcome. As we all know, technology can sometimes be finicky. If we run into any issues, please bear with us and keep in mind, we are recording this webinar to share with you afterwards. So with that, let's get into it. To reduce background noise, all attendees are automatically muted upon joining. If you have any questions throughout the duration of the presentation, you can submit those using the questions feature in your attendee panel. If you're on a computer or smartphone, there's a drop-down located in the lower right corner. For the sake of time, we may not be able to answer every question, but we will reach out to you after to ensure your question is answered should we not be able to get to it in our time tonight. Additionally, after the webinar, you will receive a pop-up that takes you to a survey. Your feedback is very important to us as we continue to expand our webinar program, so please take a quick moment to provide us feedback on how things went and what you'd like to see for next time. As I mentioned, this webinar is being recorded and will be shared to our events page in the coming week. You'll be able to view this webinar as well as all previous webinars on demand on our events page. And with that, I'm going to turn things over to Todd Moore with Trinity Debt Management to introduce himself and take us through tonight's topic.
Great, thank you so much, Kelly. And thank you for everyone this evening for joining our call. There we go. Once again, just want to welcome everyone back to the General Electric Credit Union webinar series. It's always great to be a part of the series. I'm Todd Moore from Trinity Debt Management, and it's a great topic this evening. We're going to get into credit myths and common misperceptions. I'm going to introduce some of the findings from Capital One's Insight Survey. It's an annual survey that's done just to kind of gauge where is folks' assumptions on certain lines of credit, and in particularly trying to identify maybe some of those barriers that keep us from being able to fully participate in economic life, particularly when it comes to credit. So that's one of the things we're going to be looking at tonight, some of those survey responses, and also we're going to dive into a range of just misconceptions that I believe have been around for a while. We're trying to really go after those tonight, kind of dispel some of those myths. And the goal really is to make certain that you're able to get lines of credit to meet all of your particular financial needs. So why do we want to go about this topic and really focus on these misperceptions? One is that when we have assumptions about credit, particularly bad assumptions, misperceptions, it holds us back. It's a barrier for us being able to get the lines of credit that we need. It also keeps us, it shifts behavior. And sometimes just having assumptions about lines of credit, particularly when we're thinking about things maybe incorrectly, sometimes folks don't fully participate in the services that are available to them, keeps them from being able to fully take part in banking And really, at the end of the day, it costs us money and opportunity. So I'll share with you now some of the insights, and then we're going to cover a range of just misperceptions that I think that are in the market, that are kind of circulated even among media, and just things maybe that even some of our peers have even shared with us, folks that we interact with, things that we hear kind of with our colleagues. So let's take a look now at some of the results from Capital One. So this is a survey that was done, and it's a peer-reviewed survey, but Capital One has done some really good work on this over the years. I wanted to highlight at least 4 of these areas, and then we're going to go into a whole range of other kind of myths and misperceptions throughout the evening. If you happen to have one yourself that you're thinking about that you'd like to share with us in terms of questions as we get towards the end, please do that. I'm always interested in some of those misperceptions that may be out there, or just things that maybe you're thinking about. Make certain you take note of those now, share those with us, and I'll do my best to answer those questions. And if I don't have the answer, then we'll work with the credit union and others. We'll make sure that we get an answer for you. Okay. So what were these results from Capital One? What did they find? So this first one really has a lot to do. 70% of Americans incorrectly believe that just having too low of a score just keeps them from qualifying for any type of credit card. And I'll just introduce a couple of these and then we'll dig into the details. 68% incorrectly believe that paying utility bills in some ways can improve credit capacity, improve your score. 37% incorrectly believe carrying a balance, and this is something we hear all the time, does carrying a balance on my card actually help my score? I was told if I carry some type of balance on there, it's better than having it paid off. And what I thought was interesting here is through this Capital One survey that this misperception continues to grow. More and more folks, I think particularly younger folks, you can see where once someone has heard that information, that shifts behavior. People start to reason through that misperception. It becomes reality. And then we go to this 27% believe that checking their credit will negatively affect their credit score. And another 19% said they just don't know. I was a little surprised by that result because we've done a lot, looking at credit scores and tried to, in some ways, dispel that myth about being able to check your credit without having a negative impact. But as you can see, it does linger, and we'll be talking more about that tonight. All right, so let's dive in here. Let's start with our myths. I call this the low score assumption, okay? And we're going to tie this back to the Capital One survey. So here we're looking at this idea that, respondents were asked questions about, just overall credit score. How does it affect you from qualifying for lines of credit? And, whether or not if you have a score that's too low, does it keep you from any type of credit? Now, we know that there are scores that matter. So if you were to walk into GECU and you were to think about, applying for a line and the score was too low, not having that minimum score, it does matter. It does matter. But this question really is trying to get us to think about those who are just not involved in banking services, or maybe missing opportunities to re-engage with the credit union in ways to help improve scores, or maybe rebuilding credit capacity. Sometimes this assumption, just my score is just too low, I'm not going to be able to rebuild it. The banks don't want to work with me, credit union doesn't want to work with me. We want to dispel that myth now. This low score assumption, the reason that we do this work is because we're here to help you. We can certainly raise your capacity, improve your score, and we want to really dispel this misperception, this myth. The problem with that is once that becomes a reality for folks, this low score assumption, is it keeps people from being able to, get the lines of credit that they need, or maybe they rely on secondary financial services. So if you have questions about your score overall, and you believe it's maybe too low to qualify, that's why we're here tonight. We want to be able to help you. So certainly you can reach out through my contact information at Trinity Debt Management. But we partner with GECU, the credit union. We want to make certain that you're successful. And if your score if it is lower, then we will work together to make certain that we raise that score and get you the lines of credit that you need. But let's set this assumption aside. Having too low a credit score, yes, it will have an impact on your ability to open a line of credit, but it cannot keep us. We cannot have this assumption that it can keep us from being able to rebuild the score or to fully take advantage of the services that are available to us. We want you engaged in this process, and we want to be able to help you. The next one we'll look at here is looking at utility bills. Now, when I was thinking about this one tonight, one of the things that we'll see some commercials that talk about using maybe rental payments to improve your credit score, your credit capacity, you know, using that process in some way to rebuild history. There is some work that can be done in that area using rental payments as a means of helping to improve a credit score. I'll share with you from practice, having been involved in credit for almost 17 years now, that it's very difficult to use that as a factor to see. It's so much broader than what sometimes you will see through commercials and even through that function itself, using rent payments to be able to improve scores. We want you to engage in credit union services. Those things are going to have a bigger impact on your credit capacity and your credit score. But let's differentiate here between that rental approach and utility bills. So most companies do not report, utility payments. I know that here recently, here in Cincinnati, I've addressed this myth through the office at Trinity. For whatever reason, I've seen an uptick in folks believing that, I think what they're doing is looking at the commercial for using rental payments, and they're kind of mixing the rental payment with utility bills. But the issue here is it really doesn't, these utility companies are not reporting your payment history. Okay, now they will certainly report you if you have defaulted in some way or not made payments. It becomes a collection account. In that particular case, you will see that on a credit report, but the timely payments that you make, it's not reported to the bureaus. Utility companies do not report to the credit bureaus. So what you will see in most cases is you will only see something regarding utility bills when it is a negative account, not as you're paying through that process. So for many of us, this may be a simple, this may not be an issue at all, but I can assure you that as I do some work in the community, this was surprising to me that this is becoming more and more prevalent in terms of just folks believing in this idea that utility bills improve your credit score. It will not. So again, want to speak very strongly about, making certain that if you're looking to improve your credit score and looking for products and services that do that, that's why we're here. We want to make certain that we can get the credit that you need. Utility bills, not the way to go. And this is a great one. Okay, this one has been around for a long time. Okay, this is the idea that carrying a balance on my card can help increase my overall score. Now, I get this one a lot because this is a question sometimes I think that I've read this in different kind of media posts. I've read it, when you're reviewing literature out there, you'll come across this in different articles about personal finance and those sorts of things. The idea that somehow if your card is paid down to zero, okay, that is a negative, that it's better to carry some type of balance on my card as opposed to just having it paid off. Well, we're going to dispel that myth tonight. A lingering balance on your card it will affect your utilization rate. So think about that credit debt ratio. For some of you that have gone through some of our previous conversations on credit, we look at that utilization rate. So let's say that you have $1,000 credit card. Zero means it's paid off completely, and you leave some type of balance on there, $50, $20, whatever it might be. Well, most of us are carrying more than just one line of credit. So we're going to be looking at not only utilization, but we look at the credit debt ratio. So whatever balance is lingering on that particular card is just being factored into the score model itself. So if you're carrying a balance, it's a function of your overall score at this point. So it's not a positive. It actually has an impact on the score itself. In most cases, it's going to be, a negative. Now this, I'm not trying to overstate the point, but what we're really trying to look at here is just to simplify this question. Should I pay my card off, or should I carry some type of balance in order to improve my score? Again, we'll dispel that myth for us now. If you're carrying a balance on your card, it's going to be factored in to the utilization rate. We're looking at the credit debt ratio as well in totality among all the different lines of credit that you have. Pay it down, okay? Because once we remove the debt, even whatever is left on there, again, that has an impact positively on the score itself, and that's really our goal. So it doesn't help to carry a balance. We want to dispel that now. We recognize that sometimes you may be carrying a balance, but the idea is to pay it off. And certainly there's some strategies that we can use to improve our score by, shorter term purchases and paying them down. But just carrying a balance on a card, it's not going to improve the score. All right, soft inquiries. This is another one. Soft inquiries lowers my score. Now, again, I was a little surprised by this result. And this is another one that has recently had an uptick with this particular myth. I've dealt a lot with this. I don't know if it's maybe because folks are getting back in the market potentially for jobs and they're concerned about employment checks being soft inquiries, or maybe I haven't figured it out yet, but we're going to dispel another myth tonight. Soft inquiries will not affect negatively on a credit score. Okay, there's no adverse effect. There's no impact negatively to your score. Now, we want you to be able to check your score. So if you think about the range of tools that we have, we can check through annual credit report. Credit unions will often have a way to monitor credit history on websites. There's all sorts of ways to obtain this information. But the idea is that we're learning about the scoring model itself. For credit scoring purposes, we're not asking anyone to loan us money. It's simply looking for information. It's for educational purposes and information, just reviewing the score. That's a good thing. And it's intended, it's designed to be that way. So we can differentiate between a soft inquiry, looking for information, monitoring our score, as opposed to a hard inquiry, which is where we'd actually ask, for a credit check to be able to qualify in some way for a line of credit. But just looking at overall inquiries in terms of soft inquiries, and I've dealt a lot with this recently, questions I think probably are starting to emerge about maybe employment checks. Those are soft inquiries. So when you're thinking about, you fill out an application for a job, it asks for some type of credit score check. There's information that's on the credit report that an employer may be looking at to qualify you for a position, but they're not necessarily looking at a credit score. Now that may be a little different in the financial services market, but most of us that are applying for jobs outside of that area, we're looking at soft inquiries for information, employment checks, trying to monitor our overall capacity, our scores. So rest assured this evening, take a deep breath. Soft inquiries, again, no negative impact to your credit score. And this is a great one. I call this one debt is debt, okay? So not all debt is the same, okay? Not all debts are equal. So we'll try to attack this question in some way. So I've given us kind of an example here, this $150,000 debt here. I'm looking at that maybe as student loan debt or some type of mortgage debt, as opposed to other lines of credit. FICO, and they don't tell us what this actually, the point value is to something that we don't have our hands on that. That's industry specific data. We don't have the ability to go in there and share that with you this evening. But what we do know is that they're within the FICO model itself, that there are things within the model that are just simply weighted differently. So certain debts are weighted differently than others. And I'll give you an example. So if we look at student loans, that's weighted differently in the model in terms of just overall debt, as opposed to saying, okay, I've got $80,000 in credit card debt or $50,000 in credit card debt, where I'm maxed out on all my cards. And there's one simple reason for this, and it's risk. Okay, so when folks are doing research, FICO statistical analysis, what they're looking at there, and all of the credit scoring models in some way are looking at risk. That's really what we're talking about, is risk. You could file bankruptcy on unsecured debt. Their research would indicate that credit card debt is going to be the highest, it's most likely. Folks who use the bankruptcy process to move those accounts into a bankruptcy and then get out of debt through a bankruptcy. So that's always highest risk. So it's weighted differently than, say, someone who might look at student loan debts, which are, at least at this point, unable to be discharged through debt. I know there's some talk about that. There are some exceptions even now. There's been recent cases before the Supreme Court about student loan debt. We're not going to get into that tonight because it gets very complicated. But we're just trying to differentiate again between what debts mean what. Okay, so this idea that debt is debt, it's not exactly true. Okay, there's a lot of myth around that. So I'll try to simplify this again quickly. High risk things that can be unsecured debts that can easily be discharged through a bankruptcy, particularly credit card debts or any other form of unsecured debts, those are always going to be under the FICO model weighted as high risk. So those are very different than, say, carrying, a mortgage and student loan debt. Because as we look at overall, if you look at your debt in totality, okay, when you look at that entire picture, car loans, student loans, mortgages, everything else, if you had to weight all those debts and compare them, credit cards or any other line of unsecured debt is weighted higher risk. It's more prone to bankruptcy. That's what the statistics would show. So it's always going to be more consequential. So debt is not debt, although debt does matter. But in terms of disqualifying for future lines of credit, or having a very high score, you could carry, a significant amount of mortgage debt and credit card debt and still have an extremely high score. But where you'll find where it becomes more problematic is unsecured lines of credit, primarily due to the risk of bankruptcy. So this is a great one to look at. Now this is one of my favorites, and I have to share, this is probably one of my favorites of the evening. That somehow we can pay to fix a credit score. Okay, now I've got it in the text here, dispute it all. So I'll share with you. As I said, I've been in the Cincinnati community working on this area for a very long time, very passionate about helping people improve their credit score, working with the credit union. And at the end of the day, just really want folks to be able to have a high score and get the lines of credit that they need. And what I've come across in my work over the years is there are a lot of folks that will say, hey, just dispute everything on the credit report, dispute it all. Okay, that's one scenario and sometimes they pay folks to do it, and sometimes they will have folks that do this as a service. But we want to really focus on this tonight because this is an important one. There are some companies, and I'm not going to name them, but there are companies that will claim that they can fix your credit score. That's very different than any type of credit counseling service. I can assure you that we're not allowed to say anything like that. We're not credit repair. But anytime that you're looking at something like this, when folks are making promises, hey, you pay us a certain fee, we'll dispute everything on your credit report, we'll improve your credit capacity, just keep sending us, the money to do that. That is what we call credit repair. That's not credit counseling. Those are for-profit entities in many cases, but I often see this in the nonprofit sector as well, where people just say dispute everything and we'll somehow clean up your score. I'm going to caution you tonight not to do that, okay? So when we're thinking about disputes have to be actual disputes under the Fair Credit Reporting Act. So when you just dispute everything on a credit report, there's a lot of action that can actually take place, because under that law, and there's a lot of subsets of that law, and it's been amended many, many times, but Fair and Accurate Transactions Act also falls under, the Fair Credit Reporting Act. We're not going to get into the legal stuff tonight, but what I'm trying to get at here is be cautious about doing that, because you're going through a process. It's a legal process where you're asking someone, when you start initiating these disputes, the burden falls on the creditors or collection companies to verify this information. And sometimes I've seen folks where they just dispute everything and they wind up having a wage garnishment come their way because, they disputed accounts that were higher dollar accounts that they thought they could get out of. And all of a sudden now it winds up at a law firm. So if you have any kind of questions about this, first of all, going through that initiation, disputing everything, reach out to us, whether it's Trinity or the credit union, and let us take a look and do an analysis on your credit report. And I'll caution you again, not to just pay folks to fix your score. No one can do that. No one can just magically raise your score. You can't give some money to someone and just have them improve your overall credit score. It just doesn't work that way. So another example of this would be, let's say that your score right now is a little lower. You have a 620 score, and at minimum you're looking at a 670. You're just wanting to become a first-time home buyer, and your goal is just to really pay some outstanding debts off, and you're trying to improve your score. If you go through an issue where if you go out and start disputing everything on the report, you wind up in many cases just having a harder time raising your scores. If you would just work with folks to go through that process, let us take a look at the report, do the proper analysis. Because again, even if you're paying off some debts now, even if you work through the analysis and we give you all the right stuff, we can't buy time. Okay, I want to repeat that. We can't go out and buy time. It takes time to report. It takes time to report on the credits, to report on the credit score itself. It takes time to build it. No one can just magically fix it. So I probably belabored the point here, but just be cautious, guys, when you're out in the market doing this. I see so many times where people have spent thousands of dollars over years of time and just lost so much. So just caution you about that. We'll dispel that myth tonight. Another great one tonight is the medical debt. So there's two prongs on this one. The myth here is that medical debt lowers my score. Okay, so I'm going to have you look at the first bullet point here. So two parts to this. So one, and this is something, again, that the idea here was that the three credit bureaus really took a hard look. A research team looked at this and said, okay, what is the impact of really penalizing folks in the market for medical collection, for medical debt? Now, I can tell you, having been at Trinity for many years, 17 years now, I used to see medical debt. It was just, I can tell you a lot of stories about that, but it was very, very prominent. We've seen it all the time, and it did have an impact. And, we would look at that. It was primarily because folks just didn't have access to health care. I mean, that's the reality of it. Folks were using other services. It would be reported back, hospitals and things like that would report them back. And many of these costs also were some of these were small dollar things that either, a consumer just got themselves into some trouble, or they didn't have all full payment, all sorts of stories. But the bottom line is, when they finally looked at the researchers saying, okay, one, let's make a change and say anything under $500 as of April 2023 of this year, then that smaller dollar stuff is not going to be reported. So now I will tell you, I see things 47, 25, 19, I mean, you name it, where it's gone into collection debt. And so those smaller dollar items, at least here defined as 500, are not going to show up on a report, so you won't see that. Now, let's go back even earlier to last year. So what we're looking at now, let's say that you're over that $500 amount. How does that affect my score? So what we're looking at here, this is the second part of this, was let's say that you're struggling. You now have up to 1 year to make some type of arrangement to pay off these medical debts. Even if you can't pay it in full, just setting up some type of payment structure is where we're going to find, this is not going to appear on your credit report for 1 year. So it used to be 6 months. So they've extended that timeline to 1 year. So these two clauses here, make sure that, even after the presentation, if this is something you want to learn more on, medical debt is not as consequential as it once was. particularly anything under $500, and it's extended in terms of time, repayment time, for you to be able to, work with someone, collection company, or even work in-house with folks that you're making medical payments to, so that it doesn't appear on a credit report. So again, it's a nice thing for us to have when we're working with folks to raise their score. The consequences are not the same as they were just a couple years ago. So again, looking at the facts and dispelling the myth. Another great one here, closing cards, will help improve my score. I'm going to close these out and, things will improve. Well, we see this a lot, and this is one, again, I'll go back and think about debt in totality, and we'll actually look at the FICO rule itself, okay? Now, if you have questions, let's say, for instance, that you, again, are a first-time home buyer, you're looking for a line of credit, I would always suggest setting down with GECU, reaching out and saying, hey, I'm in a line, I'm looking at a line of credit. Should I close this line? What's the credit impact? There's times where your score is strong. You can reduce if you're not carrying a lot of debt and your credit debt ratio is below 30%. Closing a card, regardless, is still going to impact your score. So we don't want to close accounts that are in good standing. The FICO rule is anything that's in good standing and open for longer than 7 years. We don't want to pull that out of your credit history. We want to keep it open. Also, we don't want to just be in the market where we're constantly opening and closing accounts. For credit scoring to really be beneficial, we want long-term, long-standing accounts. So where this becomes a problem, and I've talked about this in previous seminars, where this becomes a problem is that you close an account, two things happen. So we've broken the rule, and when we break that rule, that is, you've closed an account that was in good standing longer than 7 years, you're going to lose some points from doing that. And the second and most likely consequential outcome is that when you close that card, if you're carrying higher debt, let's say it's more than 30% of whatever line of credit that you have, credit card, $300 on a $900 card, just you can take any card times 0.30, 30%. What we're looking at is if you're carrying higher amounts of debt, taking the good stuff out is going to make it look as if you're carrying more debt. So now your score drops. So it's hitting you from two angles. One, you've broken the rule. Secondly, you shifted your credit debt ratio, and now your score has taken a hit. So seems pretty straightforward. It's we hear this a lot, but closing a card in most cases will negatively affect your score for the reasons I just laid out. So if you have any questions about that, closing accounts, reach out to us before you make any decisions, and we'll try to point you in the right direction. Okay, so another great one. I'm too young to worry about a credit score. I'm gonna wait. We hear this sometimes. Now, GECU has done a lot to try to reach out to our young folks in the community, particularly our high school and college students. And we've actually done some work on credit scoring and trying to get folks engaged in banking and get them in, starting some credit builder lines of credit now. Really what we're looking at here is under the Card Act, you do have to be 21 to open a card in your name, but there are a lot of things that we can do to help you in this journey now. So, if you're starting and you have someone going off to college in the family, and what can we do to help that person start to build a credit score? There's some ways that we can go about doing this. We won't get into all this tonight, but there are some ways that we can do this, whether it's through piggybacking, where we use someone else's line of credit, family member's line of credit to help establish a line. But we also want to think about products and services. So we really want folks engaged early on. Particularly, I'm looking at kids in high school. I shouldn't say kids. My daughter now is 16, so she would probably be offended if I called her a kid. But you see the point that I'm trying to make. We want our students engaged, and we want them to understand how to build credit, and we want them, to work with a credit union early on. So we can look at different options for building credit. So I want to encourage you to really, if you have a student that's going off, someone in the family going off to college, or it's in their senior year, reach out to the credit union. Let us help. Let us get a secured line of credit or a small dollar loan to really be able to start building credit. And we can also talk about some other strategies to do that. But credit capacity, the earlier we start, done correctly. Sometimes this can also go the other way if our folks are not working in the right direction. But we would like to be able to work with young people, get them engaged in this process early on, make certain that they can get a small dollar line of credit, because we know that as they're in college and they complete, a degree, they're going to need a car, and they're going to need a credit score to get a car. That's one of the items that so many folks are going to, folks want. After graduation, there's going to be cars and other things that are credit needs that have to be met. So let's build that score now while you're younger, as opposed to waiting till you get through your degree, and then it takes at least 2 more years to build the history that you need. So reach out to the credit union. Let's work together. We'll figure out a line of credit that works best for your student, and we'll start them off on the right track. Okay, so we're going to narrow down here to the last few myths. I know we're throwing a lot at you this evening, but here's another one. All the major credit bureaus base their scores off the same information. Okay, now this is a myth. We know that we have the 3 major credit bureaus in the market. Here's how this works. So not everyone's reporting the same information. Okay, so the data is going to be different. So when you think about this term, a tri-merge, so you go into GECU, you're wanting to become a homeowner, you need a home loan. What we find out is that you pulled maybe an Equifax report and you didn't see a collection account, or you didn't see something listed on a credit report. And then, all of a sudden someone at GECU says, you know what, we found this on the report, Well, there's a lot of data that can be obtained through a broader data search. So we look at across all 3 bureaus as opposed to one. In most cases, we find whatever is out there that maybe did not get reported to another bureau. And it could be any one of the 3 bureaus. It's the whole reason why we do what's called a tri-merge, where we really cast a wider net, okay? But let's just take that misperception itself. One of the things that happens is folks have to report you. So let's say it's a rental issue. You may have a rental office that does report. It might report to all 3. It might only report to Experian. So it may not ever report to the other 2 bureaus, and vice versa. You could be involved in maybe some type of payday lending type thing. Some folks may report some type of in-house credit program that they have to your bureau. Others may not. So you can see where I'm going with this. So when we think about the information that's collected, because entities have to pay to report you as a consumer, they choose oftentimes not to report to all 3. So you may find some information that is a little inconsistent across the reports. So they're not all pulling from the same well, okay? And the primary driver of that is cost. It's expensive to report all 3. I know at the office we have Equifax. We don't have access to all 3 reports. We have some very good Equifax reports, but the bank, the credit union, they have tools that are far superior to what we have. So if you do have collection accounts out there, annual credit reports are a great way to look at that, because they're very detailed. That gives us a good guide. And then as you get further into the process with lending, the tri-merge, or just looking broadly, it captures a lot. So, but in this case, just think about how things are reported, the costs that it takes to report. So you will find that all the bureaus, there's going to be some data out there that's not as consistent. And again, primarily it's because folks didn't want to pay to report you. But at the end of the day, information that needs to be cleaned up or paid, eventually we're going to find out. So if you have questions about that, again, you always want to reach out to us and let us work together so that we can improve your score and just make sure that you're successful. Okay, marriage. Let's take this one for a moment. That getting married will merge my credit score with my spouse. Now I've dealt with this one here recently as well, because right now I've had a whole group of people that over the last couple months, despite inflation, are starting to kind of think about home loans. And while inflation still is high, their score needs some work. So I think the idea is, hey, my score is a little lower right now. Why don't I work on that, deal with inflation and the price of housing and loans later? But how does marriage affect my overall credit score or our capacity? How is it all merged together? It is not. Okay, so unless you're doing something where unless you've applied for joint accounts, your credit is your credit, and your spouse, vice versa. That's the way that would work. So credit reports are always at the individual level, at the consumer level, so it's unique to you. There's nothing there that merges credit lines unless that credit line was originally set up as a joint account. And in that case, despite, divorce or whatever it may be, the credit impact will be, it will be negative for both parties. If accounts are listed, so sometimes I'll see this with marriage, with a married couple, someone's a user on a card, has access to that. They have an authorized user on a card. That can have an impact because now you've linked or joined those accounts in some way. Sometimes people try to raise scores by doing that. But here's the thing, marriage in and of itself does not merge the credit scores. And thank goodness it doesn't, because in a lot of cases when it comes to credit, particularly when it comes to first-time home buyers, we leverage scores. One spouse tends to have a little higher score than the other, and we go about it that way. Sometimes just looking at risk, we would just put a mortgage in one spouse's name, and if anything were to happen to that person, that's unique. It doesn't bring the entire house down. It doesn't bring both of us down, say something with job loss or bankruptcy or whatever it may be. We don't have all of our eggs in one basket. Okay, we're not linked in all ways. So that's another way to think about risk, is having those accounts kind of separate, unique, and just being able to protect yourself long term for any type of future risk, health, employment, or otherwise that's out there. Having it unique to that individual line of credit. So bottom line, marriage in itself doesn't just automatically merge things. It is always individual, consumer level. Okay, and this is our last myth of the evening, and thank you so much for going through all those details with us tonight. Income and demographics. This is a great one. I love this one. Your impact, whether, if we look at just overall income itself. So look at the credit variables that are listed here, payment history, the utilization rates, those sorts of things. And then thinking about salary and income. So when we're thinking about credit scoring, and this is one of the beauties of credit scoring, I think, is that it's not income dependent. So someone that has less income or lower income always has the capacity to raise and improve their score. It's not just around income itself. In fact, income is not a measure of your credit score itself, although income does matter in terms of loan amounts and those sorts of things when we're thinking about debt to income ratio and some other factors that you would look at. But strictly the scoring model itself, we have the capacity, despite income, to raise scores and move forward. That's a wonderful thing. It makes certain that we start off where we have truly the ability to improve our score despite whatever hardship we may have had or where our income is currently at. And the other thing too is about demographics. So if you look at things here, credit reports contain no information about race, religion, disabilities, sexual orientation, those sorts of things. So that gets into, things that are just not on. There's no demographic information necessarily that's related to a score itself. So that's not a function of your overall credit score. So again, we hear this, because of income, maybe I'm not able to get a line of credit that I need. If it's a case where we're looking at income and we're looking at credit scoring, they are two different issues. Income is not a function of the score itself, or the score is not a function of income, is the way I should say it. So income and demographics, again, that's not part of how we build a strong score. We have the capacity to use those other factors, which are listed here on the slide. Those are the core variables that are used for credit scoring purposes. So we have covered a lot of ground and a lot on this. We've got about 15 minutes left. I'm going to run through a couple more slides and then I'll open it up to your questions. So as always, we want you to just take a moment to think about those myths, those misperceptions. If you're in the credit market, we want you to think about what your short-term and long-term goals are. Again, first-time home buyers, you're interested in a car. Maybe you have a young person at home that is going off to school. We want to make certain that you reach out to us and let us know at the credit union what we can do to help you. Even those who may be on the call tonight that, again, let's go to that one misperception, my score is just too low. No, it's not. We can work with you. Even if your score right now was a 510 and you've had all sorts of issues and hardships, whatever it may be, we have secured lines of credit, small dollar loans, ways to work with you to improve your credit capacity that will truly make a difference for you long term. So we want to dispel that myth and we want to encourage you to work with us. Let us help you. The other thing is that obviously you can see here that I would love to work with you. If you have any kind of challenges with your credit score itself, I would love to work with you. It is a free thing that I can do for you as a partner with GECU. Reach out to me, let me know. We'll align some credit building strategies and I will send you back to GECU to get a line of credit. I won't cover a whole lot on these slides here about the Vantage score. I've covered some of that tonight and in previous presentations, but one thing that I want to encourage you to think about, and the reason I put these slides in tonight's presentation, is there is very much a difference between looking at the three bureaus as opposed to Credit Karma. I didn't list this one tonight as a myth because it's not a myth technically, but if we're in the market for a line of credit, I would encourage you to look at the major bureaus, even annualcreditreport.com. As opposed to relying heavily on the Vantage score itself, particularly like Credit Karma, because you'll see here listed on the slide, there's about a 30-point swing, positive or negative. So when we're thinking about the baseline and getting a good read, because Vantage score is a FICO score, but it is referred to as a Vantage score. There's different scoring models. So oftentimes what happens is folks will make assumptions around the Vantage score and then they find out it's not the same as what we use for lending purposes. So again, it's not technically a myth, but I would just say just a word of caution to you for those on the call tonight. Let's focus our assumptions on the information we get from the three bureaus. Those are the lending tools that we would use as opposed to the Vantage score, which is primarily for education or informational purposes. Okay, and the reason for this again is just that variation, that broad variation in the score. So I'm going to lean towards the three bureaus as opposed to Credit Karma. Lastly, we talked about credit products. I just listed these quickly. Again, going to that one credit scoring myth itself, we have secured lines, we have the traditional lines, credit builder loans, small dollar personal loans. There's so many variations on loan products, but again, this is to dispel that myth that somehow I'm just too low of a credit score to really do anything. Absolutely not the case. There's a line of credit here that we can do to help you improve. And even if your score is a little lower for the higher dollar lines that you may need right now in the traditional kind of credit realm, we can still help improve your capacity and raise that score to get you the higher dollar lines of credit that you need. So in conclusion, I wanted again to thank all of you on the call tonight. Appreciate you spending some time with us this evening. And once again, we want to make credit building count for you. Reach out to us with any of your needs. credit report analysis free to you, let us know. You can reach out to me through my contact information. I'll help you align some strategies, work directly with the credit union as well, and just really help you improve your overall score. And if you have any questions, even after the call, you can always reach out to me and let me know. This is my contact information. That's my smiling face right there. Call me at the 800 number, 800-758-3844, extension 3030. That's my direct line at the office. Let me know if I can help you in any way. And with that, I'll answer any questions. Kelly, I'll turn it back to you.
All right. Thank you, Todd, for taking us through the most common myths when it comes to credit. So we are going to go ahead and open it up to our Q&A. Sorry, I just want to make sure I get my screen back up here for anyone who wants to take down Todd's information if any questions come up after the webinar, but we'll go ahead and jump into questions. I know we received a couple during the presentation, so we'll go ahead and jump in. The first one says, I've paid off my mortgage for 5+ years. Now it is showing as a negative on my credit report to not have a first mortgage. Why is that?
So you paid on it for 5 years. Well, I'm going to have to take a look at this at the office. I'm going to encourage you to reach out to me after this call, because this one could get a little more complicated. I'd probably have to do a little digging to answer that off the top of my head. I don't have a clear answer for you right now. I would have to pull that credit report probably, and again, it wouldn't have any adverse effect on your score itself, but just trying to figure out why those payments that were made under the mortgage itself, I'm not exactly clear on why that would be the case. I hate to say that to you, but in this particular case, I would have to look at the credit report itself and see to see if I can do some digging there to figure out what is going on. I don't have a clear answer for you right now. So I would just encourage you to reach out to me with that. Let me talk directly with you one-on-one, get a little more information, see if I can give you a better answer. I'm sorry I can't help you with that one.
The next question is kind of along the same lines of mortgages, but maybe a little more vague. It says, seniors' credit scores are adversely impacted because many no longer carry a mortgage. What can be done to offset this impact?
Okay, now the way I'm hearing that question is maybe you've paid off a mortgage, you've paid off because of age, maybe you paid off a lot of different lines of credit. So maybe you're just looking at the overall credit score itself. And oftentimes what will happen as we age, we pay off debts. We paid off a mortgage. That should remain as part of your credit history. So if you're thinking about, first of all, I'd say identify what your credit needs are, depending on your age and your overall credit needs. If you're in the market for credit and for whatever reason you feel that your score isn't qualifying you, or you just need a little higher score, which does happen. So I would say that's a question where we would need to work together on those credit strategies. You could always reach out to me directly on that question. I could pull a credit report and get a better baseline of what your overall score is. But generally what we're looking at, if I'm just speaking very broadly, let's say that your score just diminished through time. Maybe you didn't have active open accounts that were listed, and the score just needs a jolt. It needs some activity being reported to the credit bureaus. We could figure out, through the credit union, we could figure out a small dollar line of credit or something that could kind of initiate some activity back on the report itself. Or if it's a deeper issue where we need to do some other credit building, we would take a look at that issue as well. So again, that type of specific question, I would say be better for me to answer in detail, through just giving me a call. But if the score itself is if it's not where you think it should be, or if it's if there's a reporting issue due to inactivity, you can see a score impact. Your score can drop somewhat from inactivity. If either one of those are the issue, you would see your score decline. But in order to improve that in some way, just give me a call and I'll be able to help you in a deeper way and to answer that more specifically offline.
And it looks like this might actually be our last question. It's asking, is it a good idea to be a co-applicant on my child's credit card application, and how might that affect my credit?
Well, there are times when parents would want to be a co-applicant. There's always high risk in doing that. I would, depending on age and, you really have to use some judgment when it comes to this. In most cases, I know that parents, I, I would probably be the same way. We're worried about the potential negatives. Let's say that we co-sign for something, we're a co-applicant, a co-signer, and there's an issue with payment. So long as there's no issue with payment, everything's fine. But oftentimes we know that if there's non-payment, late payment, all of that would impact your score. So what I would suggest in this particular situation is make it unique to the student itself or to that person at home, your child at home. If they need to build some credit, some of this is going to be age dependent as well. So if they're below 18, they're a younger person trying to get some type of car loan or something, that's one scenario. If they're a little older, it's a different scenario. But for our purposes, I would say if there's ways that we can work with the credit union to make that line of credit unique to uh, our child, I would go that route as opposed to being co-applicant. But again, that's one of those specific questions that really is dependent on age. Um, if you got someone going off to college, that's one scenario. If you got someone getting their first car that's new driving, that's a different scenario in terms of being co-applicant. But there's always risk involved. Anytime that you're signing, as you know, there's this risk involved in being a co-applicant because you're fully responsible if anything goes wrong during that repayment period. So again, I would suggest, let me get a little more detail from you, or even reach out to the folks at the credit union and let them know specifically what it is that you're looking for. Is this a small dollar line of credit to build credit? Is it a car loan? What exactly is it? And then we can align a strategy to best meet that need and lower your risk. Make certain that, if anything goes wrong, that it doesn't affect negatively on your credit report itself.
And we did actually have one more question come in, so we'll end on this question since I know we're coming up on our time. It's asking, does lowering a credit line or limit on a couple of credit cards hurt your credit? And is there any benefit to lowering the credit limit?
Yeah, this is a great question. That would have been a good one for our MISS presentation tonight. I wish I'd have thought about that one. The answer is that anytime that you modify and you lower a limit, it can be done a couple different ways. One, let's say, for instance, that you had a J.C. Penney card. I'm just making this up. Well, I'll use my own example. Due to non-activity, the idea is folks in the credit market want people to use lines of credit. Interest is a function of profit, so we need people to be able to use lines, and we use that to expand the credit market. We use that money to put new lines of credit out there. So inactivity itself, let's say, even in my own case, due to inactivity, my line was diminished. When my line was diminished, it had an impact negatively on my credit report because, and I'm not talking significant points, we're not talking 40 points or something like that, but it will, if you were to close, if you right now, you're in good standing on your cards and due to inactivity, a lender has diminished your line, that in itself will negatively affect your score because if you were carrying any type of other debt, it can shift your credit debt ratio, which will lower your score. Not dramatically, but it will have a negative impact. But if you on your own initiative went out and said, okay, I'm going to, right now I've got these 3 credit lines are all at $2,000. I want them diminished, and you ask for credit reductions of some sort. Let's just use that as a hypothetical that it was diminished. The outcome would be negative. So I would say, again, that those lines are higher for a reason. It's a reflection of your higher capacity. It's a reflection of your higher score. So we don't want to go the other way. Anytime, again, that it's done through closing an account or a lender has diminished the line due to non-activity or inactivity, it will negatively impact your score. So keep the cards at a higher balance when possible, and use them occasionally to make certain that you can maintain that higher line. Pay it off. Don't carry a balance like I talked about earlier, but buy a pair of socks or something, pay it off. But yes, to answer your question, either of those examples that I listed would have a negative impact on your score.
All right, thank you, Todd. That is going to conclude our Q&A session for tonight. If you have any further questions, Todd's contact information will be up on the screen for just another moment or so. I do have a couple of closing comments. Once again, you will immediately see a survey upon exiting the webinar. So please take a quick moment to just fill that out and let us know your feedback from tonight and how you thought tonight went, as we are continuing to expand our webinar program and love any feedback you are willing to provide. And then lastly, up on the screen, you'll see a list of our upcoming webinars. If any of these topics are of interest to you, you can visit our events page or capture the QR code with your smartphone on the screen. That'll take you there directly. There you'll be able to learn more and register for our upcoming events. And we are always adding more, so if these topics aren't of interest to you, definitely be sure to check back soon. But with that, that's going to conclude tonight's webinar. Thank you all so much for joining us, and have a great rest of your evening.